Hello, everyone. It is Monday, July 31st as of this recording. Hope you all had a great weekend. Last couple of weeks ago, I did a longer 17-minute video on second half of 2023. This video is going to be a little bit shorter, just showing 4 charts from this weekend's research. Wanted to share with where we are at seasonality-wise, and then also what's keeping us our little bit conservative stance with our portfolios here. So just 4 charts, and let's jump right into it. So this first one is on market seasonality. So in the top half of this graph, this is from Thrasher Analytics. You can see on a full year basis, the market goes up on average. That's what this is showing. This is since 1970 and showing the S&P 500. Now, if you look at the bottom, it shows month by month returns. You can see August is typically a pretty lackluster month, and September on average has been a negative month since 1970. So as we reach this more weak part of the year as far as months go, that supports kind of a conservative approach as well, and something to keep an eye on. Now, if we take this a step further and say, okay, look at seasonality, but specifically in pre-election years. This has got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 examples here, 9 or 10 examples. You can see market kind of goes up again on average throughout the course of the first half of the year. And then when we get to this middle part in pre-election years, we typically have a lull, some sideways movement, and we have several instances of downward movement. So not only do we have every year seasonality weakness, but more specifically pre-election year weakness as well. Moving to what's help support our more cautious stance here on portfolios. This particular chart was from Archaea Capital Research that I read this weekend. This is the net call put volume. Okay, so to explain what that is, these are call options, speculative investing. So if you're buying a call, you are bullish or you think the market's going to go up. If you're buying a put, you're bearish, you think the market's going to go down. So this shows basically speculative investing when it reaches these high level peaks. So anytime it gets this high, represented by that red bar, okay, look up straight up on the line that corresponds with that, you can see that this has preceded pretty significant weakness in the market, right? Some bigger than others, but with every kind of major drop that you can see here going back into 2017, anytime speculative investing gets this high or this aggressive, meaning investors are really getting confident and taking on a lot of risk, the market has, proceeded to punish that move, and you have seen some drawdown in the S&P 500. So we're up there. We're turning down already. This would support some market weakness in the near term. Add to that, this chart again by Thrasher, S&P 500 on the top, and then you can see here the percentage of stocks hitting a 52-week high in red, a 6-month high in blue, a 3-month high, and a 20-day high in green and purple. Now you can see as the market was recovering early part of this year, new highs continued to climb. Now go back here since the beginning of July. Now we're starting to see new highs start to decline. Okay, you're seeing that across every time frame. The percentage of stocks hitting new highs on these time frames is getting lower and lower. So those two things, the speculative investing and the number of new stocks reaching new highs starting to weaken in conjunction with seasonality weakness, supports our more cautious portfolio stance here for the near term. So I hope you all enjoy the rest of your week. As always, holler if you have any questions, and we will talk to you all very soon.